Learn which assets Warren Buffett considers to be the worst and greatest for an inflationary environment in this video. The framework referred to as the Investor's Protection Against Inflation Pyramid will categorize these assets into 5 groups and show them chronologically. Yes, the name is still under development. The 5 assets listed below are the worst to possess during inflationary times. Starting at the bottom of the pyramid, assets with a currency inscription. Maybe this wasn't such a big surprise. The worst thing you can possess in an inflationary situation is obviously the currency that is being inflated. Money that is hidden under your mattress or in a bank account will eventually be eaten up every week, every day, and month by month. Therefore, we don't want to maintain dollars in our portfolios if we anticipate dollar inflation. If you've played Old Maid, it starts to resemble that game since no one wants to sit on the losing card. Government and corporate bonds that contain coupons in the inflated currency will also struggle. It will not seem like a horrible bargain if I give you $100 and promise you $10 a year in return, with your whole $100 returned in year 10. That's a 10% yearly return. However, if we close this agreement and there is a 10% increase in the value of the dollar, which is not at all unlikely because it happened in the 1970s and 1980s, you won't receive any actual profits on the investment. Everyone in the United States would be ecstatic if we suddenly threw $1 million into each and every home, with the exception of those who had money invested in items with a financial value. Following that on our list is unproductive asset. This includes possessions like money, a mansion, fine art, etc. Inflationary periods are not worthless for owning these assets because on the whole, they ought to maintain their true value. They won't, however, enhance your purchasing power, which is why they don't go up the pyramid past this level. Warren Buffett explains, don't get too enthusiastic just yet, but if you were to pack all of the world's gold into a cube, it would measure around 70 feet on each side. If you had all the gold in the world, you could build a cube that was 70 feet on each side. You could then mount a ladder to the top of the cube and proclaim, I'm sitting on top of the globe. You could, stroke it, polish it, and do all of these things with it. But it won't do anything. Any of the non-productive assets are the same. The unique painting will still only be one uncommon painting in 10 years. It will never multiply, unlike assets found farther up the pyramid, which have the potential to do so over time. If you want to accomplish more than merely maintaining your buying power through unproductive assets, you will have to undertake a very challenging task. You will need to predict how terrified people will be of inflation in the future. Actually, the situation is more intricate than that. A little game will make it clear why this is a challenging task. Let me know in the comments if you have any other questions about investing. Let's return to the video. Next, productive assets, mediocre type. Unproductive assets are fantastic at preserving their actual worth during periods of inflation, but our goal is to raise the real value. Productive assets. Assets that create useful services or goods are said to be productive. You are aware that Warren Buffett enjoys making investments in stocks and companies. However, not all companies are created equally. The first kind of business you should avoid in an inflationary environment is one that needs massive amounts of additional funding in order to survive. Unfortunately, most firms will struggle to survive inflation in real terms. Over time, their income may increase somewhat, but they must continually invest more money in the company in order to maintain their position. The worst form of business is one that always requires you to put more money on the table while not increasing your revenues. Here is a fictitious illustration that perhaps will demonstrate the idea. Tony is hawking gum at a neighborhood school. Each year, he places a large purchase with Alibaba for 1,000 worth of chewing gum, which he then sells in his classes for the next 12 months. With a 10% profit margin, he has $1,100 in his pocket after a year of sales. The next year, he chooses to place a new order for $1,000 and the same quantity of chewing gum, giving himself $100 in returns. Let's now examine what would happen to Tony's company if there was an annual inflation rate of 10%. For the sake of simplicity, this devaluation will take place overnight between December 31 and January 1. Tony's sales brought in $1,100 again at the conclusion of the year. However, the price has doubled when he decides to purchase from Alibaba the next year. Gums have become 10% more costly. Therefore, Tony needs to pay the entire $1,100 to get the same quantity as last year. He proceeds to order despite his disappointment. Due to inflation, Tony's sales climb to $1,210 the next year. Yet he must once more invest the same amount only to replenish his inventory the following year. Keep in mind that if this keeps happening, Tony will never be able to withdraw any money from his company. These are frequently the companies having low returns on physical assets in the actual world. To determine this, multiply a company's earnings by the total of the balance sheet components known as receivables, inventories, other current assets, and net property, plant, and equipment. The next type of company to stay away from is one with no pricing power. The businesses that, despite periods of inflation, cannot afford to raise their prices. Wait, shouldn't inflation increase the cost of everything? The answer is yes, although it frequently does so with a significant time lag. For instance, if a person notices that a barber is raising his prices by $10 a year, they could opt to get a haircut themselves, forgetting that their own wage has increased by the same amount. For firms with financial issues, bankruptcy may result if costs grow with inflation, but revenues do not. Finally, and this one should go without saying, you won't fare well during inflationary periods if you own a company that also controls a significant portion of the assets farther down the pyramid. This is not simply a hypothetical scenario. On their balance sheets, banks, savings and loans, and insurance companies all contain large amounts of cash and bonds. Inflation was a contributing factor in the savings and loan crisis. In the United States from 1986 to 1995, 1,043 out of 3,234 savings and loan organizations failed as a result of the savings and loan crisis of the 1980s and 1990s, according to Wikipedia. We're now coming to the interesting part. I'll name it productive asset, a great type. Here's another blown-out illustration for you. Kate, a classmate of Tony's, writes a song and posts it on Spotify. Her expenses for renting the studio and paying the DJ to mix the music for her were $1,000. She now receives $100 a year in royalties from Spotify. In other words, she is making 10% just like Tony did in an inflation-free environment. What happens if inflation rises by 10%? Kate makes $100 her first year, as was to be expected. Inflation then occurs. The benefit of Kate's company is that she doesn't need to provide further funding for it to continue operating. Due to inflation, she will make a profit of $110 the following year and $121 the following year, all of which is free cash flow. She can take the money with her and use it elsewhere, or she might invest it again to add more songs to her music library. The three qualities listed under the mediocre kind of productive assets may be completely reversed to provide the three qualities you are searching for in a firm that will operate well during inflationary periods. The following is what you seek: low capital needs and excellent asset returns. This is the place for companies with well-known brands and other software firms where there are significant economies of scale. Second is pricing influence. Although estimating pricing power is a challenging task, it is important to understand competition, substitutes, and customer power. You may assess these factors using Porter's 5 Forces framework. Little to no cash needed, and ideally, some balance sheet leverage. Sadly, even this class of investments is not a sure thing, especially if everyone comes to believe it to be. Even for companies with high pricing power and minimal need for capital investment, you might overspend. Even while it's an excellent location to look at, a good business is not always a smart acquisition. By the way, Buffett rarely discusses other productive assets like farms and rental properties, but these likely fall somewhere in between these two groups. Although maintaining these assets in operation normally requires some cash, you may leverage them quite a bit. Charlie Munger explains on the situation with debt during the 1920s German Weimar Republic. However, if you have a really high mortgage on a home and there is enormous inflation that eliminates the mortgage, you still have the house. In Germany's Weimar, you eventually receive your mortgage back. It was quite fascinating. The only thing they did well was that a few of the mortgages were essentially revived as payment to creditors. Always keep in mind that leverage has two sides. Now, your own financial capacity, and if you're the top lawyer in town, the top brain surgeon in town, or whatever it may be, you don't have to be re-educating yourself to be that in modern terms. You didn't have to keep reinvesting because you already paid for your education in old money when you attended medical school or law school. Additionally, you keep your earning potential in today's money. Yes, investing in yourself and increasing your value to others is the best defense against inflation. Regardless of the value of the currency, be it Bitcoin, seashells, Reichsmarks, or dollars, you will always control a certain percentage of the products and services produced by others. Additionally, since your debt will be reduced if you borrowed much to attend an Ivy League university, you will do even better during inflationary times. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.